Are you getting superior performance? And the answer unequivocally for the industry as a whole is no. There's no scientific evidence that mutual funds outperform a simple strategy of holding the market index.
I interviewed Warren Buffett, I interviewed Carl Icahn, I interviewed the most brilliant investors in the world. Every one of them says for 90% of investors, 90% of their money should be in the index, meaning the S&P 500 or a version of that, where you own all the best companies. And the reason you want the index is that 96% of mutual funds, the ones they're showing you on your platform, a 401k, 96% will never match or beat the market in any 10-year period. They might do it this year or next year, but it's the long term that matters. And if you think you're smart and you're going to say, I'm going to find the 4%, I'm going to do my homework, it won't happen because the 4% is always changing. If you play blackjack and you got two face cards worth 20, and your inner idiot says, I think I'm going to get an ace. You have an 8% chance of getting an ace in that situation. You got a 4% chance of getting the best mutual fund.
One of the ultimate dirty secrets of the fund industry is that a lot of people who run other fund companies own index funds in their own accounts and don't talk about it unless you put a couple beers in them.
The average actively managed mutual fund carries an annual expense of 1.3%. Some funds charge a fee of 2%, and even as high as 5%.
That may not seem very much, right? You know, you've got $50,000 or $100,000, and okay, so you lose $500 or you lose $1,000 a year. That's what you would pay to a financial advisor, right? But if you add that up over 20 or 30 or 40 or 50 years in a 401k plan, all of a sudden you're well into the six figures as your balance grows. And that's the difference between running out of money before you die or having a little money left to pass on to your heirs.
A lot of 401k programs are lousy. The fund choices stink. The fees are outlandishly high. And in many cases, you can take two next-door neighbors, you know, living on Maple Street in any town, USA, and one person is paying 10 times as much to invest in a 401k as the other person.
I think the biggest obstacle for Americans today is that most of us have been hypnotized into believing that finance is so complex that we just got to give it to somebody else. We all know that we should put money aside, but most people delay it because they say, I don't have enough money right now. You don't have to become a genius. You just have to understand what to avoid as well as what to do. I think the first place people have to start to become financially literate is look at where their money is, and let's look at the 401k. We have an industry, so everybody understands, that's a 4.4 trillion with a T size industry that for 30 years didn't have to tell you what they charged you. What company on earth, what organization could not tell you what they're charging and get by with it? 3 years ago, they were forced to change. And the law was changed that you have to show people what you're charging. So the industry's response is to build these 35 to 50-page disclosure documents that if you're a lawyer and you've got a degree in finance, maybe you can understand. Most Americans believe that they pay nothing for their 401k. There are no fees. There are fees, and they matter. Here's how they matter. Every 1% in fees that you're paying for whatever investment you have, because of the growth of compounding, that 1% that you're giving away is 10 years of retirement income.
To understand this fee business, I went to talk to someone who has thought long and hard about it. Jack Bogle, the founder of Vanguard. He says that if you want to improve your retirement outcome, make sure to minimize Wall Street's take.
Costs are a crucial part of the equation. It doesn't take a genius to know that the bigger the profit of the management company, the smaller the profit that investors get. The money managers always want more, and that's natural enough in most businesses, but it's not right for this business. What happens in the fund business is the magic of compound returns is overwhelmed by the tyranny of compounding costs. It's a mathematical fact. There's no getting around it. The fact that we don't look at it, too bad for us.
Well, I was invested in everything. Stocks, mutual funds, you name it. We would get monthly reports. Things were growing. Everything was growing. In the 90s, you could not lose money in the market, even if you were a dumb investor. I mean, it just kept growing and growing and growing.
Internet stocks drove a powerful surge on Wall Street today.
Internet stocks suddenly...
The economy was doing great. I mean, you had all kinds of gains in the stock market. That was kind of the dot-com era.
Those internet stocks continue their meteoric rise.
You really didn't have to pay attention to, you got your statements at the end of every quarter and you were making money.
It was exciting because gradually over time, we would have a day where we would make $7,000 or and as much as $30,000 in a day as it built, and even more.
In 1996, we had doubled our money. We had almost 500,000. Steve Shulo and Dan Robertson believed they were headed for early retirement the day their portfolio topped $1 million. It was November 11th, 1999.
Oh, that was a very nice day that day, wasn't it?
What happened November 11th?
See, it's when our portfolio went over $1 million. So that was just amazing. It was like, well, yeah, this is how investments work. You invested and it grows. I mean, that's how I thought about it.
It was a manic Monday in the financial market.
Stocks plunged. Traders are standing there watching in amazement, and I don't blame them.
But in the spring of 2000, the market collapsed.
Say a lot of their customers are freaked out.
We did not know. This is our mistake. We didn't know it was a bubble. We just didn't know. Our portfolio had gone all the way down to where it was in 1996, from 1.5 million to 500,000.
460, I think.
All that was gone.
At the height of the internet bubble, Americans had also stuffed 19% of their retirement money into company stock.
We invest all of our 401k in Enron stock, absolutely. Don't you guys agree?
For savers like Debbie Skaczynski, who worked for ComDisco, a computer leasing company, the fall would be precipitous.
I was close to $500,000 I had in my 401k with company stock. It was like, wow, look at all the money we have. Look at what is happening. I can retire probably when I'm 45.
The dot-com failures continue to mount.
Skaczynski not only lost her savings, she lost her job.
Cisco today filed for Chapter 11 bankruptcy protection, including another 200 job cuts.
Joined a who's who list of corporate bankruptcies for 2000.
The day I got laid off, I lost it. I thought, oh my God, I'm a single parent. I have no job. I have a house payment. What do I do? And I was scared, really scared. I didn't have much of a retirement left. I couldn't even borrow against it. And it was just something that I never foresaw, ever.
8 years later, savers were hit again.
And the mortgage market is far from over.
This is volatility we haven't seen, of course, since way before you and I were born.
More trouble ahead for the nation.
When the housing bubble turned into the crash of 2008, it put retirement even further out of reach.
The economic turmoil of recent years is putting a comfortable retirement at risk for many Americans.
It was like, holy smokes, how do you stop the bleeding?
The reality of what you've lost is huge.
Right.
I mean, not only have you now lost half of your 401k.
If it took 13 years to accumulate $80,000 and 1 year to lose half of that, and then try to get that back in another 13 years and only be at the $80,000 that you were 13 years ago, the math doesn't work.
You've just witnessed 2 bear markets since the year 2000. Unfortunately, bear markets always come in threes. And now we're going to witness the reality of what's ahead of us very, very shortly. So please pay close attention here. There are proven bear market facts since the tulip bulb crash of 1634, the South Sea bubble of 1711, the Florida real estate crash of 1926, the Asian crisis of 1989, and our current market that started in late 2000. As you can see in the 3 charts here, there are a minimum of 3 massive bear markets in a lifetime. Each of those 3 bear markets has a minimum of 3 separate declines of over 40%. The third decline has always proven to be the greatest, 50% or higher. That third decline also extends time to retirement by a minimum of 20 years. The price to earnings ratio, or PE ratio, is a ratio for valuing a company or index that measures its current share price relative to its per share earnings. This chart illustrates the historical S&P 500 price to earnings ratio, or PE ratio, and it dates back to 1890. And you can see with the 2 bars, the red top bar at 20 and the lower bar at 10. Once the earnings per share of the market go above 20, they have to collapse to below 10 in order to find a bottom in every single case. Okay? So when you look back to the 1920s, when we had the crash there, you'll see the big crash. That was the Great Depression. It bounced down. Okay? Then for years it went on, went above, bounced back down. Then back, you can go up to the 70s and the big crash of the early 1970s where the stock market dropped almost 70%. Now, you can see the bubble that's been created, and then you see the tech boom bust. Look at the PE ratios. They were way above 20. So the market had to come down. And this is what you see. And today, okay, we have a PE ratio of 26.65, well above the 20. In order for the stock market to come back to value, it has to drop below 10. So as you can see, it's making its way down. It doesn't happen overnight. It takes time. Okay, right up here, okay, is the first crash of 2000 to 2003. This is the 2008 crash. Well, we have one more to go. Okay, remember it comes in 3, right? Okay, of the 3 deflationary declines within a bear market, we've completed 2. 1 and 2 that you see here started in 2000. So remember early on in the presentation how I mentioned that 2000 was actually the start of the bear market. We are actually in the bear market, have been in the bear market. And we're doing our best to make gains through the signals during that bear market. Okay? Our third wave decline, which is larger than the other 2 that we've learned that earlier, is coming. It's inevitable as PE ratios have to come down below 10 on average on the S&P. What you see here is the likely annualized returns over the next 20 years. What this basically is showing you is that based on the PE ratio, what the likely returns are going to be. And these are statistically proven, historically proven, all the way back to 1890 to 1910, okay? So these numbers are real, and they show you exactly what the expected return is going to be. I do the pink box because you can't tell where in that area it's going to be, but that's generally where we're at, because if we have a PE of 26 down here, 26.65 down there, we also have to look over to the left here where you see the 20-year annualized returns. Well, if that's the case right now, and we come straight across from 0, you'll see that our returns are going to be just barely above 0 or negative for the next 20 years based on this. So the concept that we're going to be making great money by staying invested when there's a bear market signal in the long run is a falsehood. Okay? Understand that as long as it stays above that 20 and does not get to the bottom of 10 or below 10, it's not going to start back up for the long run. Okay? That's the lesson here. Okay, so let's sum this up and get to some real numbers. We're on the third part here, the PE less than 10. It has to get to that point before the market is done collapsing. Well, what you've seen, if you correlate this, is number 1 is the first decline, which was this. Okay? Back in 2000 to 2003. The second decline, okay, occurred with the PE ratio in the markets in 2008 and very, very early 2009. We are now climbing, and we're at the point where historically, you know this, you've seen the research, just showed you just a few minutes ago, that the third decline is the greatest. okay? It's the biggest, deepest, hardest hitting decline, okay? And if it's not started already, it's right here to begin, okay? And when that comes down, it's going to have to come down to below this line, okay? Which means the stock market is going to go below this low of 2009. It's going to happen, okay? Let's take a look at what that means in terms of your investments in your retirement account, which are the real numbers, okay? In order for the market to be in line with all prior bear market corrections, the PE ratio must settle between 4 and 10, which today means if you take the 26 of the PE ratio today, you subtract 10, which is the baseline, is equal to 12. You take 12 and divide it by 26, and you get a 61.5% minimum decline just to come back to normal. That's your 401k plan down 61.5%. That's what that means. That's your discount brokerage accounts that are in mutual funds down 61.5%. Just for the markets to get back to even, okay? And get back to value. Which one of the declines on this slide can you afford? Because it never settles at 10, okay? It usually settles below. So at 9, if it settles at 9, there's a 65% decline. If it settles at 8, it's a 69% decline. If it settles at 7, it's a 73% decline. 76% if it bounces off of 6. And if it goes down to 5, which it has before, it's an 80% decline. Sure, you'll make gains on the way up, but you certainly better have a tool that will help you avoid these types of declines. You now know it's not a matter of whether there's going to be a bear market crash. It's just a matter of when. And are you protected? Can you afford a 30, 40, 50%, 60% or more decline? We might give back 10% from the top. But that's nothing in comparison to half or more of your money.
You know, if it took 13 years to accumulate $80,000 and 1 year to lose half of that, and then try to get that back in another 13 years and only be at the $80,000 that you were 13 years ago, the math doesn't work.
Do you want to be like the Featherstones? Waiting 20 years or more to get back to even? You don't have to. That's what the Wealth Preserver is all about. Subscribe today.